Good day, everyone. For this session, we are going to discuss about financial statements analysis or analysis of financial statements. Our source would be the book of Smart and Meganson for our respective discussions. So hopefully you are going to bear with me for this particular session. Then allow me to show the PowerPoint presentation for this. This is financial statements, including cash flow analysis. So for sure, at this point in time, you already know what the financial statements are, what compose the complete set of financial statements. If you forgot, so make sure to check out my other videos discussing about PAS1 presentation of financial statements. So to begin with, we have here the financial statements. So we have two approaches actually, the accrual-based approach and the cash flow approach. So if you say accrual-based, this is accrual basis of accounting. This simply means that income and revenues are recognized or recorded when they are earned. So when is income or our income earned? Normally, if the goods are delivered and the services are rendered to the consumers, customers, or buyers. In addition, if, for example, the significant risks and rewards are transferred or relinquished to the buyers, customers, and consumers. Also, if, for example, management control has been relinquished to these buyers. So that's when income is earned. In addition, expenses are recognized and recorded as to when they are incurred. So when, for example, resources have been used or consumed or utilized already, and payment or timing of payment is not necessary. So, I mean, expenses are recognized when they are incurred regardless of when they are paid. So this is the definition though coming from our source. Revenues are recorded at the point of sale. That's true, and costs when they are incurred, not necessarily when a firm receives or pays out cash. So the timing of the receipt or payment of cash is not important. So in other words, income and expenses are not synonymous to cash, or let's say receipts and payments. Another one is cash flow approach, wherein we recognize income and expenses when cash is collected and cash is paid respectively. And this is used by financial professionals to focus attention on current, meaning the present, and perspective. So this would be the future inflows and outflows of cash. All right, so financial management is really focused about the cash flows of the entity. So how much really would be the cash flows of a particular entity. To continue, so we have here the financial statements of the entity. It's possible though that the financial statements as presented here are not yet the IFRS financial statement, so they could be utilizing the old terms. For example, the balance sheet. So balance sheet is, of course, used by US GAAP and then carried forward under earlier versions of IFRSs. However, this is changed to statement of financial position. Income statement, of course, will be showing to us the performance, whether we are profitable or losing. So if we are profitable, that's called, of course, the result of the operations is called profit. While if the opposite is true, that is a loss. So negative performance. And then if we now include OCI or other comprehensive income, so we call this the statement of comprehensive income. Income statement is just a profit or loss, but if there are OCI items, then that makes or constitutes total comprehensive income as presented in the statement of comprehensive income. So make sure to check out the video for PAS or IAS 1. Next, statement of retained earnings. This is the financial statement that shows the balance of accumulated profits and losses of the corporation. So especially if not all of the earnings of the entity, so not all of the profits have been issued in the form of dividends, and they're not also appropriated for certain purposes. So if we're done with corporation accounting, so you know these things also. And then statement of cash flows, which is very important because financial management is very concerned about the cash position, so cash flows of the entity. All right. And in addition, the notes to financial statements. So these are the 5 comprising the set. However, there is the 6th one, the additional statement of financial position, when there is or is, of course, reclassification of items on the financial statements, or there is a change in accounting policy, or let's say there is a retrospective restatement of amounts or values, for example, because of prior period errors. So that's the 6th one. However, to simplify the illustration, so normally we focus with financial statements on the face with these values, the common ones out of the 5. So 1 to 4. All right, so let's begin with the specific discussions on a specific financial statement. So the balance sheet or the statement of financial position will be showing to us the 3 accounting elements, which are the real accounts or permanent accounts or the balance sheet accounts that would remain after we close the nominal accounts, namely income, expenses, including drawing also. So a firm's balance sheet presents a snapshot view of the company's financial position at a specific point in time. Financial position would show to us the standing. So where are we in our targets, or where are we in terms of the finances of the business? So by this basic accounting equation, assets equal liabilities plus stockholders, old term, new term is shareholders equity. So it must be balanced at all times. 2 sides must be balanced. It's not allowed that one side is greater or heavier than the other. At all times, the 2 sides should be equivalent or equal to each other. That is our assumption. And then we can also notice just by this equation that assets, which are the resources of the entity or economic resources, are financed by 2 sources. The liabilities, which are the debt, constituting the debt, and stockholders' equity, the equity. The debt or financial obligations are the so-called creditors' claims because the creditors, meaning to whom the corporation or the business borrows money or buys resources on account or with the promissory notes or borrowing money with the notes. So this would be the creditors' claims. On the other hand, stockholders' equity is the claim of the stockholders or shareholders or investors of the corporation. So we can then say that assets are financed of certain percentage from liabilities and certain percentage from the equity. So that's the story of balance sheet. In addition, we will be seeing normally 4 things on the balance sheet. So this is based on the source. Even Lopez discusses this one from Counting 1, in which there are 4 items that we can see on balance sheet. So we have liquidity, which means that this is the ability of the company to pay currently maturing obligations. So obligations that will be due within 1 year or exactly 1 year or less. Then solvency, on the other hand, is the ability of the entity to pay long-term obligations. And to pay the long-term, it must be that the short-term should also be satisfied in the process. Then another one is financial structure, which is what I've said a while ago, that we can analyze what percent that assets come from the creditors and what percent that comes from the owners or the investors or stockholders or shareholders. And finally, that is capacity for adaptation or financial flexibility. So how flexible and how agile a certain entity can adjust itself in terms of finances for certain cases, could be unexpected things or transactions or situations, also could be investment opportunities that can happen along the way. So that is the story of balance sheet, and those are the four things or four items that we can see or view from the balance sheet or statement of financial position. So here's an example of balance sheet for Global Petroleum Corporation. So you have here the balance sheets at 2 years, 2008 and 2009 in millions of dollars. And here are the assets. So current, non-current. Fixed assets, by the way, is a US GAAP term, which simply means fixed assets synonymous to non-current assets. Then liabilities and stockholders' equity. So current liabilities and long-term liabilities, including deferred taxes, which should be presented at all times as non-current. Then the components of shareholders' equity or stockholders' equity, the old term. By the way, we need also to know the old terms because not all financial statements would be using the IAS equivalents. So common stock, also known as ordinary share, paid-in capital in excess of par, also known as share premium, retained earnings, accumulated profits and losses, treasury stock as treasury shares. So we have here the total liabilities and stockholders equity. So this is the presentation of the balance sheet, of course, as suggested and shown in our standards, even from IAS 1. Next to that will be the income statement. So income can be a profit, earnings, or margin whenever we attach a word prior to that, because income is a word that needs a certain word prior for it to be clear. So if you attach the word gross income, so that means the margin, the gross profit or the margin. Okay, then income. So probably the income that is being discussed here means the profit or loss, meaning the net amount, revenue minus expenses. Then measures of income could be gross profit, which is the difference between sales and cost of sales, operating profit or operating income, that is normally the income prior to taxes. So prior to deduction of taxes. Other income would be sources of income other than the main line of operations of a business. So for example, if the business is a retail business, so let's say there are some additional income, like let's say if they have interest earned from deposits made to the bank, or interest income for loans extended to certain entities or employees or people, so that's under other income. Then earnings before interest and taxes, or EBIT, is before the deduction of interest and taxes. So normally the difference is that for operating profit or pre-tax income, so operating profit is same as pre-tax income depending on the book's law, but that's the observation that I've seen. And earnings before interest and taxes will be, of course, prior to the deduction of interest, while operating profit and pre-tax normally has already deducted the interest, not the taxes. So we can say it's earning before taxes, EBT. Then the net income or net profit is after taxes. So whenever we hear the word profit or loss, normally we think that's after tax. So here is an income statement for Global Petroleum Corporation for 2 years. These are comparative financial statements, by the way, for the balance sheet or statement of financial position and the income statement. From sales, then we can notice here gross profit less the operating expenses. So we have the operating profit. So a highlight though that other income was not yet added to gross profit to be able to highlight operating profit. So profit from the operations or main line of business. So other sources of income are not yet included. So if we add that, that will be the earnings before interest and taxes, or EBIT. If we deduct interest expense, so here is the pre-tax income. So by this illustration, this is really a good illustration by which we can really know the terms or the differences of the terms that we should know. So one highlight is gross profit, sales revenue minus cost of goods sold. We have known that already. If we deduct the operating expenses, that will be equal to operating profit, which is again the profit with the main line of operations of business. If we add other income, so we get the earnings before interest and taxes, or EBIT then. If we deduct further the interest expense, so that's the pre-tax income. So this is the earnings before taxes, EBT. Then less taxes, which could be current or deferred total taxes. So we have net income, the net profits, which is after taxes. And then if we deduct the preferred stock dividends, so we get the earnings available for common stockholders. Then we can extend further. So we can notice here by this illustration that we get the amount of earnings that would be extended to retained earnings. However, the dividends supposedly should have been shown in the statement of changes in equity, which is actually the mandated financial statement to be used under IAS 1. But we will know as to why the presentation here is statement of retained earnings then. So we also have other information as shown. So you have here the earnings per share. So that would be the earnings available for common stockholders divided by the number of shares available. So these are the outstanding shares. Dividends per share is the dividend total amount divided by the number of shares outstanding, and the price per share would be the market value per share, right? So I intentionally made that smaller because I cannot view the lower part or end. Okay, so statement of retained earnings, on the other hand, as what I've said, the requirement of IAS 1 is statement of changes in equity. However, why is this presented? Well, before, under the US GAAP, most especially this is a source from US, statement of retained earnings was actually allowed. So the statement of retained earnings, even up to now though, is allowed if ever the changes that are available are only net income and the cash dividends paid. However, if there will be, for example, share premium, items of other comprehensive income, including reserves, for example, so no more or not allowed statement of retained earnings, we have to prepare statement of changes in equity. And the statement of retained earnings will show to us the net income and the cash dividends again, paid and declared. Declared is important. So this is an assumption that declaration is same as payment, with a change in retained earnings between the start and end of that year. So we can compare like what happened to the balance of retained earnings. And this is how. So it increased. Beginning is 3,670. Ending is 4,271. What is the cost of the increase or net increase? Because of the net income and the deductions for the cash dividends for preferred and common. And the net amount then is the increase of the retained earnings. Right. So to continue for financial statement, statement of cash flows will be showing to us the net cash flows provided by, if positive, used in, if negative, to the three activities of the business. So operating, if we talk about the operations, so the short-term operations day to day, if not day to day, then regularly in a month or a certain operating cycle or year or accounting period for that matter. Investment, for additional assets which are being acquired or sold, then normally non-current assets. Financing would be with respect to our non-current liabilities, so long-term obligations, because the current obligations would be part of operating, including equity. So financing would be the sources of financing. Is it through debt or equity? So long-term, though, as emphasized, because the short-term obligations, again, would be part of operating. So these are the three activities that would be having the cash flows. And cash flows could be positive or negative. If positive, that's cash inflow. If negative, that's cash outflow, including changes in the cash and marketable securities during the year. So these are some of the things that we can see, important things though, on the statement of cash flows. On the other hand, if we talk about additional information, so we have the notes to financial statements, including statement of compliance with PFRS, the summary of significant accounting policies, then the computations, calculations, the detailed information, and other information there at the end. Notes to financial statements emphasis, though, that the notes could be 100 pages if you think, while the previous financial statements could be just 1 or 2 pages. All right. Then another one is cash flow analysis. Now, although financial managers are interested in the information contained in the firm's accrual-based financial statement, so I said a while ago about that basis, but then again, for financial management purposes, the financial managers are very focused on the cash flows. Because to be honest, if we don't have the adequate available cash flows, then we cannot pay our obligations on time. We cannot fund and sustain our operations to lead to growth, and we cannot compensate owners. We cannot give dividends to the people that provided capitalization to the business. So in that case, the firm will fail. So that's why for financial management, cash is very important. It doesn't mean, though, that profit is not important, but it is less of a concern under financial management. So here is a good diagram or illustration about the firm's cash flows, subdivided into 3 activities. Let me read this part. The firm's reservoir of liquidity containing both cash and marketable securities. So not only cash, that is basically the legal tender bills and coins would be under cash flows. We also include unrestricted cash, so even deposits for the bank, cash in bank, even the petty cash fund. So the funds available for short-term purposes like tax fund or payroll fund or any other funds available for short-term purposes and earmarked or set aside for short-term, they're cash. The check that is to be encashed immediately or can be in cash immediately, that's part of cash. Marketable securities also could be really part of the cash flows because they have actually values that are not going to change significantly in the short term, and they can be converted into cash immediately in the short term. So it's impacted by changes in operating, investment, and financing cash flows. I've mentioned this, that operating cash flows would focus on the main line of operations of the business. So I said labor, materials, the wages, liabilities, the production. So all things, all items that can happen for the operations will be part of operating. Then investment will be for the purchase or sale of the non-current assets or fixed assets. Financing flows would be for borrowing or repayment of long-term debt, and the equity will be these items, stocks and dividends. Although we have to respect that the point of view here sometimes, because financing could be also short-term. Well, short-term normally, if this particular short-term obligation is not the one that is part under operations. So example, if that short-term debt is about borrowing of money that's going to be under financing. This is the exception to the rule. If a short-term liability is related to borrowing of money, but if the short-term obligation is related, even in a form of promissory note, for the purchase of assets on account, short-term, by the way, short-term assets, so that's going to be part of operating flows. Because if it is like the purchase of non-current assets, so of course the assets would be part of the, let's say here, the fixed assets or the non-current assets, but if it does not involve cash flow, it will not have impact on the firm's cash flow. So anyway, the credit should be cash to be part of the firm's cash flows. Here, because that is short-term borrowing of money, so the debit would be cash, meaning it will form part of financing. So I hope that is clear. Then another thing is that for, again, the short-term accounts payable, because that is in relation to the purchase of the merchandise, for example. So current assets, when we pay that, so that's going to have impact on operating. A while ago, I mentioned about equipment that is purchased on account. So initially, that's not going to have impact. But when there is payment, so that's going to be part of our investment flows. Okay? So here, investment activity. Business equity, I think we have to really differentiate the two. The business equity that is shown here is in a form of investment. When we invest in the equity or shares of another corporation, for example. So basically the example that is investment in subsidiary or investment in associate under IFRS 3 and IAS 28 respectively, or even investment in joint ventures for IAS 28, or investment in branch or franchise. So those are long-term investments which are part of fixed assets or non-current assets. Therefore, they should be part of investing activities. But the equity that is shown here is the very own company shares. That is, so I repeat, the equity here is going to pertain to the very own shares of the corporation issued, as well as the dividends. So these are the three activities that the firm could have cash flows, whether inflows or outflows. All right. So that's the first part of the discussion for financial statement analysis and cash flows analysis. So stay tuned for the next part. Thank you very much.